Hello, sex kittens. Praise be to Woden. Estimated vehicle miles driven on all roads, United States. Population adjusted. Nicely done by Doug Short. What a man. So we can ask ourselves from this, because we can see the shape of the chart, we can easily see that it goes back from 1970. It's got one little dip in the 80s, early 80s, 80, 81, the doubler dip that happened back there. Very rare, these double dips. And that was because of the price of oil going up, the price of gas. And it probably caused the recession, and it caused that estimated vehicle miles driven to go down. Americans like to get out on the road, and it's been going up ever since, except for this little turn down, and it's still turning down. Now we can ask ourselves, is America getting more efficient? They don't have to get out on the roads anymore. They're doing everything by the internet, and everything's so much more efficient, and I think the answer is no. They would like that to be going up. Americans like to drive, they like to be on the roads, and they like the freedom of it all and everything like that. This means that there's something going wrong in America. America wants to drive and it can't drive. And it points us towards the price of gas. And that could well be causing quite a lot of our recession, even the world recession that we might be moving into now, the price of gas. Let's move on. Led by improvements in production related. I don't need to go into that. These people say that the Chicago Fed National Activity Index increased a little bit and that sort of stuff. The chart, which is much more, charts talk better than words so often. Going back to 1967, right at the end, we can see the huge dip down. It came up, it went down at the end, but it's had a little tickle up. So yes, the Chicago Fed index has gone up a little, but it's still below the zero line. And really, to say it increased when it's below the zero line doesn't tell us much. It's not good. But it's better than it going down when it's below the zero line. So let's do some talking from the Daily Telegraph online from the United Kingdom. He said, it doesn't matter who said it, that although the situation was tough, it would be wrong to underestimate the chances of America avoiding recession. Now, I think this is quite true. Normally, I would, America seems to be going over 1%, between 1 and 2% GDP growth, something along those lines. But America's like a big jumbo jet type economy, and it needs more speed to keep it in the air. It needs over 2%. So I'm not underestimating it. They are doing better than everybody else. But the fact is, what we have now is a global economy in the idea that even 5 years ago, the last little recession thing even, that wasn't a global turn down. There were emerging markets that still trundled on quite nicely. But I think everything is now turning, click, 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 and it's all meshed in now. And we could well have a global economy. In other words, when there is a recession, it will be a global recession. And when there is the next boom, it will be a global boom. And this is very bad because you imagine the volatility this is going to cause. Huge, great ups and downs. But, harping back to the opening, I think that what we're going to have is the potential for a global boom. But as the global boom kicks in, it's going to hit that ceiling of the price of cheap energy, which ain't going to be cheap because the price will just theoretically go up, but it won't get to the up because it'll already cause that global, what would have been a boom, to turn down again. So we're going to go from global recession to global just about hanging on, back to global recession. Oh dear. Maybe it's because I'm doing some decorating inside and everything in the house is all turmoiled over that I'm feeling a bit depressed about things. But maybe it's because there are things to be depressed about. Anyway, he also said that many multinationals were placing more and more investment in the emerging markets of the BRIC countries. Quite true, but I mean, that's not good for the West, is it? That means all the production is moving to the BRICS. Turning to Europe, Sir Martin said that issuing of Eurobonds across the Eurozone was an idea he supported as part of the solution to the debt crisis in the continent. He also said there needed to be a larger stabilisation fund, that's the EFSF. Euro contagion, that is of concern again, he said. Angela Merkel and Nicolas Sarkozy didn't put anything together in terms of a Eurobond or an increase in the stabilisation fund to support things. No, they did not. A different article in the Telegraph. China has become a crucial prop for the Eurozone, accumulating some 700 billion euro of EMU bonds over the past decade. As it seeks to lower its dependency on the US dollar, Beijing has pledged support for Italy and Spain over recent months, but there are signs that the Politburo is losing patience with Europe's leaders. For now, the European Central Bank is shoring up the Spanish and Italian bond market. It bought a further 14 billion euros worth of Eurobonds, of Eurozone bonds last week, etc., etc. So China's getting a bit pissed with the Eurozone leaders not finding a solution. Well, they could say what the solution is, because nobody seems to know what it is. ECB, there it is. Well, the ECB is capping yields of Italian and Spanish bonds. The central bank comes in and does it with funny money. Back to America. Corrupt Obama administration pressuring New York attorneys general to support mortgage whitewash. This is Eve at Naked Capitalism. And she doesn't go in for corrupt and words like that just offhand. She's a pretty careful girl. She's getting, when I've been following this, generally I've been posting from Eve. She's been following this, and the more you look into it, the more corrupt seems to be the correct word. Revealingly, one of the administrations, that's the Obama administration allies, said Wall Street is our main street. And the worst is that this remark may not be a cynical Ministry of Truth pronouncement. Team Obama bears all the hallmarks of being so close to banks and big corporations that it has lost all contact with and understanding of mainstream America. And there's another problem. The economics are biting up through from the bottom of the wealth pile up. And at the top, things are just gangrenous, rotten. Bloomberg, Wall Street aristocracy got 1.2 trillion from the Fed. Citigroup, Bank of America were the reigning champions of finance in 2006 as home prices peaked, leading the 10 biggest US banks and brokerage firms to their best year ever with $104 billion of profits. That was in 2006. By 2008, the housing market collapse forced those companies to take more than 6 times as much, $670 billion in emergency loans from the US Federal Reserve Central Bank. The loans dwarfed the $160 billion in public bailout the top 10 got from the US Treasury, yet until now the full amounts have remained secret, and well done Bloomberg for squeezing the truth out of them. And Bloomberg put together this interactive chart, number 8, of the borrowing of those financial institutions and some not so financial institutions. Morgan Stanley at the top, an investment bank that still exists. Citigroup, basket case. Bank of America, because of many things, but what Eve's been following of the mortgage shenanigans, the housing market blew up in America because it was rotten, not because just it was a boom and price collapse. There was corruption. Bank of America, with Countrywide stuffed in it, are at the centre of it. Number 4, Royal Bank of Scotland. What the hell are they doing there? State Street Corp, if anybody's, they've got their fingers in everything. UBS, Switzerland, Goldman Sachs, that still exists not as an investment bank. It's a bank holding company because there aren't any investment banks anymore. They all need connection to the Fed's windows to get money when they need it, so they've given up their status, and they're all just banks that can go to the Fed, the central bank, to suck on their tit. JP Morgan, Deutsche Bank, German, Barclays, British, they're the other people with fingers everywhere. Merrill Lynch, they've gone. Credit Suisse, they're Swiss. Dexia's Belgian, I think. Wachovia have gone. Lehman Brothers have gone. Wells Fargo should have gone. Bastards. Bear Stearns gone. BNP Paribas, we've seen that they're really shaky at the moment, and the really shaking the markets with their exposure to various sovereign debt. Hypo Real Estate, they got the German government came in and took them effectively over huge quantities of money. Fortis, Norinchukin, that's Japanese. Commerzbank, more German. Dresdner, more German. HBOS, British. SocGen, they've been causing trouble in the markets, from France. Guggenheim Partners, Hudson. AIG at the bottom, insurance company, they tried to bail it that way. General Electric, what the hell are they doing there, etc. Central banks, so essential now that to give liquidity when necessary. And this has set a precedent for the huge quantities of liquidity that the central banks will give, which gives the entire structure an awful lot of wobble. It's going to be very hard to knock it down, but you can imagine it's just unimaginable, isn't it? But central banks are just crucial to this now. This looks like Telegraph again. Perhaps oddly, I'm not as uber bearish as some at this juncture. This sounds like Ambrose Evans Pritchard. It is far from clear to me that the US is crashing into a second slump. Fair enough. While the Philly Fed's manufacturing index for August was catastrophic at minus 30.7, it's a twitchy index indeed. What goes down? It could have been just a strange data point out of where it should have been. Somebody at Capital Economics says it flashed warnings in 95 and 98 wrongly. Andrew Haldane, the Bank of England's financial stability chief, we had him yesterday. I would be very happy if you'd gone to the LSE site and seen his presentation. Among the others, says global banks have raised equity by 500 billion since the bubble burst. I won't read any more, but I'll just say that raised 500 billion since the bubble burst in equity, that's a wonderful way of putting it, and I wish they'd put it that way more. Andrew Haldane trying to educate us. When they say banks raise capital, you think that to be borrowing. It's not. It's equity. It's stock. It's selling part of the company off. I can't go into banks' balance sheets. You've got assets on one side, you've got liabilities on the other, and below that, balancing off the assets is the equity. So if there is an imbalance between assets and liabilities, and the liabilities, if there's more money needed, it comes out of equity, which is what banks call capital. And it comes out of equity, which means the shareholders, the owners of the companies, lose their money. That's their buffer. I can't go into all this. Eastern European growth coming rapidly off the boil. Edward Hugh, not just an expert in Spain, one of his specialities is Eastern Europe. And they're not coming off greatly, but because so many of them work through Austria and Germany, Czech Republic, Hungary, Slovakia, Bulgaria, Romania are all running into trouble because the core Eurozone is slowing down. Michael Pettis, my favourite expert on China, emailed Mish Shedlock. Via email, Michael Pettis at China Financial Markets shared his outlook for China, Europe and the world. It's a long article, but well worth reading if you're interested. The overall outlook is not pretty, Pettis says. It's not pretty, and includes a breakup of the Eurozone, a major slowdown for China, his speciality, and a smackdown of the much-loved BRICS. if the core of the world, the people that buy things, stop buying things, then the others, the periphery that make things, will crash worse than the buyers. The bricks, the periphery, the emerging markets make things, and people must buy them or they crash big style. Australia will crash if China crashes. China will crash if America crashes. It's an integrated world. G'day Pete, how you doing? Let's finish with, I know it's been long, but I had to triage these from 36 different tabs open just to get down to this. This is an overall picture for us. The survey found that for many Americans, the foundation of their retirement strategy is simply not to retire, to work considerably longer than the traditional retirement age or work in retirement. 39% of workers plan to work past the age of 70 or not to retire at all. 54% of workers expect to plan to continue working when they retire. 40% now expect to work longer and retire at an older age since the recession. Workers' greatest fears about retirement include outliving my savings and investments and not being able to meet financial needs of my family. Sorry, but it's a fact now of existence. Which gives us the final chart that since the recession started in the United States, over 55-year-olds have been finding more employment. They'll work cheaper and with their experience can hold on to jobs, and they're desirable. The younger you are, going down to minus 7.6%, or minus 7.6 on the BLS percentage scale. Younger people aren't finding jobs, so the older people might be able to keep their mortgage just about paid because they're just about holding on to their jobs. But the younger people might come along and burn the damn house down because they've got nothing better to do. No, I don't feel any better today. We'll see you again tomorrow. Bye.